Unemployment is at a 50-year low, but Fed Chairman Jay Powell said this week the labor market may have more slack than originally thought. What does that actually mean? It's time for Yahoo U. Brian Cheung is here with this week's lesson.
All right, well, class is in session, and the Federal Reserve, as a reminder, has two mandates. That's price stability and maximum employment. Now, we know that the Fed has had issues targeting inflation, but on maximum employment, the Fed thought they had it. But now the Fed says that that may not be the case. So today, we're talking about the labor market. How tight is it, and when can we call it hot? So again, we know that unemployment has been falling for some time. The most recent reading as of November was at 3.5%. Now that is a 50-year low. Now this means that among those looking for jobs, only 3.5% of people are unable to lock down a gig, and that's well below the 10% unemployment number that we saw after the crisis. Okay, so then when along this line is maximum unemployment? Well, the problem is that it's a bit of an inexact science. See, the next chart that I'll show you has a blue line. The blue line here is the unemployment rate, the same that I just showed you in the previous chart. But the purple line here is new, and this is the Congressional Budget Office's estimate of maximum employment. Now, economists call this the natural rate of unemployment. Now, this is the rate of unemployment where available resources in the labor market are supporting the normal unstimulated growth of the economy. Now, in theory, if unemployment is higher than where the economy's natural unemployment level, like this, for example, then that means that too many workers are being left on the sidelines. So that's not maximum employment. However, if unemployment is lower than the natural rate, so say, for example, in the period leading up to the financial crisis, this little sliver right over here, then that means that there might be too many workers in the market, and that might actually bid wages up as employers are competing for talent. Now, that's good, but if wages rise too fast, so could inflation, and that could destabilize the economy. So that's why they call the purple line here the non-accelerating interest rate of unemployment, or NAIRU. Now, that's kind of jargony, but basically it's the maximum level of unemployment without risking runaway inflation. Now, what's the problem with this? Well, it's forecasting the natural rate of unemployment, which is exactly that. It's a guess, it's a forecast. There's no promise that it won't be wrong. Now, here is a similar chart that I'm going to show you. In this case, the purple line is the unemployment rate. Now, we've zoomed in on the last 5 years. That's the time period that we're looking at. And the blue line here is what they call U star. That's just the shorthand way of noting natural rate of unemployment. Now, this right here, the blue line, is not the CBO's estimate, as I showed you earlier, but this comes from the Federal Reserve, those people down in Washington, D.C. that steer monetary policy. And do you notice anything about this picture? Well, the Fed has slowly revised down its estimate of where maximum unemployment is. Now, in 2015 and 2016, it seemed like we were there, right? It seems like unemployment was hitting around the level that U-star was being estimated at. And Fed presidents at the time were saying we're close or we're at full employment. At that time, the unemployment rate was about 5%. Maybe the labor market was getting too hot, they worried. So to quell any possible inflationary pressures, the Fed began raising rates. And what happened? Well, the labor market continued to tighten anyway. Look at the purple line. So the actual unemployment rate continued to dip lower than the Fed could ever imagine, and policymakers have had to lower their expectations, the blue line, for where the true natural level of unemployment is. And this week, on Wednesday, the Federal Reserve Chairman, that's Jerome Powell, appeared to acknowledge that the labor market is far from hot. Here's what he had to say.
I'll say that the labor market is strong. I don't know that it's tight because you're not seeing wage increases. You know, ultimately, if it's tight, those should be it should be reflected in higher wage increases. Ultimately, though, we'd like to see, to call it hot, you'd want to see heat. You'd want to see, higher wages.
So translation, the key here is wage growth, not the headline unemployment rate. So here's wage growth. This is the purple line. And since the crisis, wage growth has risen from below the 2% year over year level to 3.1% as of November. Now, you notice how wages have plateaued kind of recently in the past year and a half or so. Well, why? Well, is it because the Fed was too quick to raise rates between 2015 and last year? Well, that's up to speculation. Now, regardless, the Federal Reserve is now cutting rates, and Powell does not appear to worry about easing policy leading to runaway wages and inflation. I mean, let's look at the blue line, right? This is the Fed's preferred measure of inflation, core PCE. This has barely breached the 2% target over time. So as Powell says, let's let the labor market run, and let's let workers benefit from rising wages, especially those that are marginalized, those low-income workers, minority workers, for example. So with no inflationary pressures, what Chairman Powell is trying to say is, for right now at least, get it right, get it tight, let the labor market run for right now.
And don't sell yourself short. You asked Jay Powell that question, which was the last of the press conference and therefore the last of the decade.
That's right.
Brian Cheung doing that for us.
Hey investors, Zach Guzman here. Are you interested in learning more about the markets and getting the latest financial news? Well, then click right here to subscribe to our Yahoo Finance YouTube channel. Get the latest up-to-the-minute market analysis, big interviews in the world of finance, and information on how to manage your money every day wherever you are.